Hey everyone, welcome back to The Explainer. I am absolutely thrilled you're here today. We are putting on our professional market analyst hats to run a top-down risk assessment of the global markets. Whether you're actively managing your own portfolio or just trying to make sense of these wild daily market swings, our job right now is to cut straight through that noise. We're going to look at the exact intelligence, the specific data points, and the structural shifts that are driving market volatility today, straight from our June 11th intel. Let's get right into it.
Okay, so here is our roadmap for today. Number 1, global geopolitical portfolio risks. 2, tech sector volatility explored. 3, leadership shifts impact confidence. And 4, upcoming rates and economic data.
Starting with Part 1, Global Geopolitical Portfolio Risks, Assessing the Macro Environment.
Right, so understanding global stability is literally the crucial first step for any portfolio manager or day trader today. Before we even think about looking at a specific stock, we absolutely have to look at the global map. Based on our intelligence today, we're seeing some significant developments overnight. U.S. forces have carried out a second consecutive day of strikes on Iran. Now, the targets in these operations specifically included Iranian air defense and surveillance sites. Concurrently, looking at the broader diplomatic picture, peace talks are currently stalled. And as market analysts, we have to look at these events strictly through the lens of market-moving data. These are just the objective facts on the ground right now that are setting the stage for global trading.
So the real question is this: how does this geopolitical tension actually create portfolio risk for you? Take a second to really think about that. Stalled peace talks and active military operations introduce immediate uncertainty into the market. Think of portfolio management during times like this as, well, it's kind of like trying to drive a car on a highway when a massive, heavy fog suddenly rolls in out of nowhere. What do? You immediately slow down, right? You grip the wheel tighter and you brace for sudden stops. That is exactly what global capital does. It seeks safe havens, it pulls away back from riskier assets, and it creates this environment where overall market sentiment is just incredibly fragile.
Moving on to Part 2, Tech Sector Volatility Explored, the Cost of AI.
Let's shift gears from that heavy global macro environment and zoom in on some specific sector action. We're seeing some real growing pains in the AI boom right now, specifically with Oracle. So Oracle had originally forecast a massive $50 billion for their annual AI-related data center spending. But the actual spend, that came in at $55.7 billion. That's a $5.7 billion overshoot. And as a result, Oracle's shares took a hit. Think of this like doing a huge home renovation. You budget $50 grand for a kitchen upgrade, right? But then the contractor hits you with a bill for $55.7 thousand. Now, even if that brand new kitchen definitely increases the long-term value of your home, your immediate reaction is probably stress and a serious tightening of the wallet. Well, markets react exactly the same way to these massive capital expenditures. It causes this really intense short-term nervousness, even when there's clear long-term strategic value down the road.
And that nervousness, it really isn't isolated to just infrastructure costs. We're actually seeing a pretty steep drop of up to 5.9% in Alibaba's Hong Kong-listed shares today. This drop seamlessly connects tech sector volatility not just to how much cash is being burned, but to internal corporate strategy and, crucially, how that strategy is actually executed, which perfectly sets up our third core topic.
Part 3, Leadership Shifts Impact Confidence. Who is at the wheel?
At the end of the day, human execution dictates investor confidence. When companies are navigating these really tricky transitions, whether it's pivoting to AI or pulling off a major brand turnaround, investors look super closely at exactly who is at the wheel. We can compare two very distinct leadership crises right now that perfectly illustrate how executive instability translates to immediate risk for retail investors. So on the tech side, remember that 5.9% drop for Alibaba we just talked about? Well, that happened as Alibaba replaced the CEO of its DingTalk app right smack in the middle of an internal AI strategy debate. A debate over the future direction of AI literally caused a change in command. Then, over on the retail side, Nike CEO Elliott Hill is facing immense pressure as expectations for a company turnaround are really weighing heavily on leadership. Whether it's a tech giant debating its AI software or a legacy retail giant trying to fix its supply chain and brand appeal, changing the captain of the ship while you're navigating a storm, that makes investors incredibly anxious.
To really put that anxiety into perspective, just look at this dramatic figure, 45%. That is how much Nike's stock has fallen. This massive drop emphasizes exactly why investors increasingly expect this turnaround to take years, not months. Turning around a legacy company is literally like trying to turn a massive cruise ship in the middle of the ocean.
It takes a ton of time, a lot of space, and highly steady leadership. When the stock is down 45%, the pressure on the C-suite is at an absolute boiling point, and that creates major volatility for anyone holding those shares.
Which brings us to part 4, upcoming rates and economic data, navigating the calendar. All right, so we've looked at the geopolitics, the tech spending, and the leadership changes. Now we really need to look forward to the specific macroeconomic announcements that will completely dictate trading momentum for the rest of today. This is basically your exact roadmap for this afternoon's trading session. Seriously, get your highlighters out for this timeline. At 15:15 GMT plus 3, we get the European Union's main refinancing rate and their monetary policy statement. This is absolutely crucial for European market sentiment. Then, literally just 15 minutes later at 15:30 GMT plus 3, the US releases its Core and Standard Producer Price Index, or PPI, month-over-month data. Now, PPI measures inflation at the wholesale level. If this number comes in hot, it signals that inflation might still be pretty sticky, which directly impacts how investors view the chances of future interest rate cuts. These are the precise minutes today where you can expect some sudden, serious spikes in market volume.
Let's bring it all together. Here is a clear 3-step checklist to help you navigate the rest of today's market using the intel we've unpacked. Step 1. Monitor geopolitics. Keep a very close eye on the headlines regarding those stalled peace talks and any further developments in the Middle East. Step 2. Track tech spend. Remember the Oracle and Alibaba examples we talked about? Watch closely how companies are handling their massive AI investments and the internal strategies behind them. And finally, Step 3. Watch the EU and US data. Be ready at exactly 15:15 and 15:30 GMT plus 3 for those crucial central bank and inflation numbers to drop.
I want to leave you with one final, vital question to ask yourself as you look at your own investments today. What is your biggest portfolio risk right now? Is your exposure most vulnerable to this current geopolitical instability? Are you maybe heavily weighted in tech companies that are struggling with these massive AI expenditures? Or are your positions highly sensitive to today's upcoming rate and inflation announcements? Figuring out exactly where your personal exposure lies is the absolute key to smart investing. Thank you so much for joining me for today's Structured Explainers, and I'll catch you next time as we continue to break down the exact data driving the markets.